Welcome to the Executive Compensation Podcast. I'm your host, Ryan Harvey. On this episode, I'm joined by Christina Medland and Michael Rourke. Christina is a managing partner at Meridian working out of Toronto, and Mike is a lead consultant working out of Detroit. Christina, Mike, welcome to the podcast.
Thanks, Ryan. We're both really happy to be here and to have a chance to discuss this very interesting topic.
Great. Happy you're here too. So today we are going to be considering compensation programs through a different lens, through the lens of an activist investor. Most companies dread the prospect of dealing with an activist investor. However, today we're going to discuss how evaluating your compensation programs as if you were preparing for activist may reveal gaps in your design that should be addressed. Addressing your compensation structure through the critical investor perspective could make your programs more effective and resilient. You'll also be better prepared if you are faced with activist investors, which may become more prevalent as universal proxy access makes challenges from investors easier to initiate. So, Chris, I'd like to start with a basic question. When an activist investor chooses to challenge a company, they generally are accepting or attempting to generate value from an underperforming company. So why would executive compensation be something that they would care about? And also, why should someone listening to this podcast care about what activists think?
Activists look at compensation programs really from two different perspectives. The first, I would say, is a more fundamental perspective. They are really looking at the alignment between pay outcomes and investor experience. And they're looking at this alignment of pay and performance, I think, almost as a barometer for how companies are thinking about the relationship between pay and performance. So it's almost a sort of a health check when they are looking at compensation programs from that first perspective. The second perspective, though, and maybe the more interesting one, is that activists will look at compensation very much from a tactical perspective. And what they're really looking at here is whether there can be a wedge that they can use to gain traction, either with the board or the shareholders. And they're trying to use that wedge to drive their business agenda. And they're looking for issues that might resonate with other shareholders, or even issues that can be used to embarrass the board. So if they can do some analysis that demonstrates that compensation payouts are really high and performance is worse or lower year over year, or if they can demonstrate that you're paying your CEO in the top decile for bottom decile performance, they're happy to use that information. It's not that it is fundamental to the case they're building, but it really is a wedge or an entry point for them to try and get attention from the board. So when we think about the second part of this, which is why should anyone listening care? And I guess from my perspective, why do our clients care? We think they care because really there's two groups of companies. There are companies that think they may be the target of an activist, or in fact are the target of an activist. And there are companies that are just looking at this from a different perspective. Companies that think they are or may be the target of an activist want to look at their compensation programs and eliminate as many of these wedge or embarrassing compensation issues as they can. This isn't going to deter an activist, but it will moderate the nature of the attack. It'll moderate what an activist can say, how they can say it, and it may even make the process less uncomfortable for the board and the executives. Mike is going to talk a little bit later about some of the red flags that are these wedge issues. But for other companies that have no activist on the horizon, looking at your programs through the lens of an activist is really a great way to bring a disciplined review of your compensation programs. And this is the real focus of our session today. It's really, how do we use the activist lens to step back and look at our programs as an activist would look at them. And this helps our clients at least really understand whether their pay and their performance are fully aligned.
That's a great perspective. And yeah, we spend so much time trying to avoid angry investors, but I think this is a very interesting way to approach things, to maybe, like you said, identify some of those areas that could be improved, or that we could make adjustments to in advance of a potential challenge. So, Chris, you alluded to red flags, and Mike, maybe we can shift into that conversation and get into a little bit more specific details around some design areas that activists tend to focus on. So what are some of those, red flag type of issues that might get the attention of an activist investor?
Yeah, it's a great question, and there can be many. And I think on the surface, you'd probably expect that maybe it's quantum of pay or the magnitude of pay, and it's not necessarily the case. It can be, but in our experience, most activist investors have their own unique playbook. Some of those primary red flags are, activists deeming that certain levels of non-performance based pay are maybe inappropriate, and this is things like supplemental executive retirement plans or SERPs, excessive severance, or even outsized perquisites like the use of a private aircraft or the tax gross ups that are provided to the executives. They may also focus on compensation committee actions that have been taken in the past, like the use of discretion, maybe providing larger payouts than the activists believed were appropriate, or maybe not aligned with company performance, or maybe their own experience as a shareholder in the business. Some will focus on realizable pay compared to performance. So their assessments is a little bit more tailored, a little more custom than you'd expect from the proxy advisory firms, where they're doing a test for the masses. So it tends to try to put everybody in the same box for a variety of reasons. But an activist investor will have very tailored, targeted analyses. They may use different peers than you do. They may look at different incentive plan metrics than you use, but they'll have their own quantitative support, generally speaking, for their perceived disconnects. They could also look at the ratio of CEO pay to other named executive officer pay, which may suggest an autocratic CEO, disproportionate decision-making authority. Another one that comes to mind too is the use of aspirational peer groups. For better or worse, revenue for most industries tends to be a primary driver of pay outcomes. So using aspirational or larger peers in your group, specifically if you use several of them, could skew target pay benchmarking, which could be a wedge they could use to push their agenda a bit. And I've also seen very nuanced criticism of pay programs broadly, and frankly, for just things that they don't like. And everybody has a different opinion on the effectiveness of certain vehicles or performance metrics. Some may dislike the use of stock options, where others may be favorable. So there really are a variety of issues, to Christina's points earlier on the wedges they may use.
Yeah, and a lot of the things you went through, I think we would also categorize those as just good governance items that many comp committees are already really focusing on and trying to avoid. But it's a list sounds like that investors are also focused on. Chris, maybe to get a little bit more philosophical, if we think about how an activist investor approaches compensation or how they think about pay, is there anything different about how they look at compensation that might be different from the way most comp committees consider compensation?
Thanks, Ryan. Activists look at pay in a fundamentally different way than most of our compensation committees. They spend very little time or energy thinking about target compensation, benchmarking, and other norms. So what this may mean is that you providing some of the usual backup, hey, we benchmarked our CEO's compensation to a peer group, and the pay level and the pay mix, all of those are within norms. And that's not going to persuade an activist that everything is okay. On the other hand, they are much less likely to complain about unusual structures or even high pay if there's strong alignment between that pay and performance. So that's what they don't focus on. They don't focus on the things that most of us spend our days focusing on. But what they do focus on is this strong link between pay outcomes and performance. And from our perspective, as compensation consultants, we think we should be assessing those pay outcomes through a realizable pay analysis. And in that analysis, we look at the alignment of pay as it is realized, seeing changes in share price and incentive plan outcomes, and how that aligns to performance. And we do that analysis relative not just to the company over a historical period, but relative to the peers. And it's that kind of a realizable pay analysis that gets you a little bit closer to how your activists are likely to think about your pay programs. They'll also focus on the metrics that you choose. And one of the surprising things about many activists is that they will be very focused on your business. And very highly attuned to the metrics that drive value in your sector, the metrics that your peers will use, and they'll want to see those value driving metrics reflected in your incentive plans. And then the last perspective, which is different from a lot of compensation committees, is really what they think about in terms of sharing of value. So they'll look at the percentage of your EBITDA that you pay to your CEO in compensation relative to what your peers do. They'll look at your CEO's pay as a percentage of the market cap or incremental market cap, and they'll compare it to peers. We've done this analysis for clients in the past, and it sometimes shows really quite shocking or striking differences between the value that's shared with shareholders at one company and another company. We call this a millions for billions analysis. But the flip side of that is that they are perfectly happy to pay millions or even hundreds of millions to executives that drive billions of dollars of value for shareholders. And we see this followed through with activists who actually become members of the board because they often bring or push companies to adopt high compensation programs, but on a much more performance contingent and leveraged basis than maybe the company had in the past.
No, all excellent things to think about. You know, we're all right now dealing with, I think, working with many different companies as we record this podcast going into a new year. And many of our clients are thinking about, you know, setting goals and setting targets for various incentives and long-term incentives and so forth. So I think this is all very pertinent to those questions. And many of the things you just went through, Chris, really get around that question of goal setting for incentives. So maybe, Mike, let's get into some specifics there. Are there ways that activist investors specifically think about the topic of establishing incentive targets that would be helpful for us to understand even now as we approach the new year?
Definitely. And it often diverges from how companies themselves think about goal setting. You know, for example, when setting goals, you know, many organizations, if not most, will use this bottom-up approach to setting an operating budget, taking all the inputs throughout the organization, rolling them up into a plan. And it's typically and ideally that aligns with your target setting process and the goals you use in your incentive programs. So it's really this internally focused exercise that companies and undertake and committees ultimately approve. Now, that's not always the case for activists. I mean, not only do they not have access to all that information at all times, but they tend to use more of an external focus. They'll often compare your incentive targets and the resulting payouts to organizations that they deem to be close business comparators. And again, that can be different than the peer companies that the organization selects for benchmarking compensation or even performance for that matter. They'll look to see if your targets are at or above historical results for relative to selected peers. Is there this upward trajectory of performance year over year? One thing that could significantly draw some ire is really on the performance and payout leverage curve when considered in totality. So, for example, you as an organization, are you paying out a maximum bonus for achieving 5% EBITDA growth when your competitors are paying out target for that same level of growth? It's really this relative assessment of the entire curve that the activists tend to focus on more holistically. You know, now that being said, they will do some internal assessments as well for some company specific outcomes. You know, they may be looking for goals they deem to be soft or sandbagging is another term we often hear from time to time. They're looking for payouts for performance that's maybe worse year over year. Payouts that occur when a company misses the guidance it gives to the street. You know, they're also testing correlations between your financial performance outcomes and the resulting stock price performance, because at the end of the day, that's where their value creation comes from as an investor. You know, I can think of an example of a client that comes to mind, which really lends to how nuanced some of the feedback can be when it comes to goal setting from an activist perspective. This company was in a turnaround situation, manufacturing setting, significant capital requirements, and the industry shifted and they needed to take a different strategic direction. And there was going to be a period of time where, for better or worse, the return on invested capital, which was the goal they used in their incentive program, was going to be less than their weighted average cost of capital. So in theory, their they're destroying value. But it's this turnaround situation where the company still wanted them to, or the committee that is, still wanted management to focus on improving ROIC as the business righted the ship, so to speak. And an activist became involved based on that goal setting exclusively and drew a clear line in the sand where they didn't want any payouts for any reason for return on invested capital that didn't exceed the company's weighted average cost of capital. So it's really a good lesson on how the finest details can be used as not only a wedge for the activist investors, but things you should think about as a committee, not only for your own goal setting process, but how you think about displaying and relaying your message publicly through your proxy statement.
Yeah, no, that's a great example. So let's maybe shift here as we move towards the end of our conversation and get really practical. Maybe both of you can just kind of go through. I'd like to think about some very practical steps that companies should be considering now if they want to think like an activist and really evaluate their programs. So what would be some of those practical steps that they should be considering?
I'll start with a few, and I'm sure Christina has more to add here as well. First, I would say, know your shareholder base. Understand who they are, how they vote on say on pay. Do they follow proxy advisory firms, ISS and Glass Lewis, or do they have their own models, which is probably more likely, at least for the larger funds at this point? Do they have their own approach? Do they have their own things they like or dislike from a design perspective? This really helps with some of the guesswork and anticipating how they may react to your pay program design before they may potentially become involved on the activist side. The second I'd say is along the lines of shareholder outreach, be consistent. For many companies in today's day and age, this is an annual ongoing process. They reach out to shareholders each year, offer them the opportunity to meet and discuss the pay programs and other things that may be on their mind. This not only helps you stay ahead of any concerns they may have, but they really appreciate the opportunity to have one-on-ones and, give you their side of the story, the things they may look out for from not only a pay design perspective, but performance expectations. And I think you can draw some conclusions reading between the lines of it when you do that prospective reach out, and some will decline the opportunity to speak. And it's not necessarily a bad thing. They may have no grievances and no reason to feel the need to be heard. And the last one I'll say before I pass it over to Christina would be, look at your compensation programs over a multi-year history. It's really easy to lose the forest through the trees when we look at pay programs and the actions the committee has taken over a one-year period. So do things like annualize your historical short and long-term incentive payouts over a multi-year period. Consider how your thresholds, targets, and maximum goals have progressed over time, especially within the context of actual performance outcomes. Compare your performance and the pay outcomes for that matter relative to peers, sort of this back testing approach to make sure that that the pay outcomes feel right from a company's recent historical performance perspective. Take an honest look at your performance metrics and your target setting. Is weak or strong outcome, is a weak or strong outcome leading to weak or strong share price growth? Is there alignment there? And really the idea there is the executive's experience tracking with shareholders. And if it's not, that's one of the easiest wedges to use. And lastly, keep track of the committee's discretionary actions that have been taken over time. And the reason that's important is it's easy from a year-to-year basis when you realize what's going on in the business to make adjustments for whatever factor. But over a multi-year period, there should be a balance. And it's not necessarily 50-50 upward or downward adjustment over time, but it's for the things you are making adjustments for. Let's say, for example, that's commodity prices. In the events commodity prices increase in 1 year, did you make an adjustment to your program? If so, when commodity prices declined in another year, did you take the inverse action, demonstrating balance to how the committee assesses the need for adjustments and the outcomes that the executives ultimately receive?
That's great. Chris, anything you'd add to Mike's list?
Sure, I'll jump in with just a couple of suggestions. The first really relates to the CD&A in your proxy. I really view this as the first point and probably one of the most important points of shareholder engagement. This is where you get a chance to tell your story, to tell how your pay aligns with your performance. Be transparent where you can and where that's reasonable, and use graphics and tables to make the story a whole lot easier to understand. One of the important things that companies sometimes don't do is provide the appropriate business context that actually supports the pay outcomes. And those kinds of narratives really help your audience, your shareholders, your investors understand what it is you're doing. And then get ahead of your potential pay and performance concerns with prospective disclosure. If you are in an environment where your share price has been declining, this may be a good opportunity to provide some graphs illustrating that realizable pay for your executives has tracked very closely with what's been going on for your shareholders. The second is, I guess, more of a comment about you can no longer please everyone. There are so many voices and opinions out there, and increasingly we're seeing the policies and perspectives of investors diverge both from the proxy advisors and from each other. It's no longer possible to chart a path that satisfies all of your investors. And when you broaden that to include stakeholders, you see that it is near impossible to make everyone happy. And so you need to do what's right for your business first and foremost. So as a part of this and looking at it through the investor lens, you want to take a step back and try to look at your compensation programs from different perspectives. Get the opinions of other members of your board who are not on your compensation committee. Try to poke holes in your own design. Have your consultant do a critical analysis of your target setting and pay outcomes, or a realizable pay analysis. You don't need to disclose these, although these may be tools that you find helpful to use for disclosure in some circumstances. But it's really important for you as a committee to really understand how your pay programs are working. And then I guess I was just going to finish with a kind of major caveat to all of this, and which is at the end of the day, activists are trying to target companies that are underperforming direct business peers. Good compensation practices can eliminate a number of these wedge issues. They can certainly make the process less uncomfortable and less embarrassing for the executives and the directors involved. But at the end of the day, if you are an underperforming company, managing these wedge issues is not going to be enough. You may be the target of an investor, and you're going to need a strong public story about what your business strategy is, what you are doing to become more competitive, the challenges you need to overcome, and the timing. Shareholders who are investing with a full understanding of what the plan is and what the timing is are much more likely to support the company than shareholders who really feel like they are kept in the dark until an activist shines light on what's going on at the company.
Excellent point. And Christina and Mike, I think you've really given us all a valuable perspective on how an activist investor thinks and how it might shape how committee members and others think about compensation. So thanks again for coming on the podcast today. I really enjoyed the conversation.
As did we. Thanks,
Thank you.
Thanks.